The dollar is strong, yields are rising, and gold is above $5,100. If you have been in these markets long enough to know the textbook, you already know that combination should not exist. A strong dollar makes gold more expensive for global buyers. Rising yields give investors an alternative to a non-yielding asset. Both conditions together have historically been enough to send metals lower. And yet here we are on March 11, 2026. DXY sitting near 99, the 10-year Treasury yield pressing toward 4.16%, and gold trading between 5,149 and 5,223 hours this morning. Something in the classic relationship has stopped working. And what that something is, that is what this entire video is about. Last week I told you to watch the gold-silver ratio at the 55 level, with the CFTC Commitment of Traders report on Friday, March 14th as the trigger data. The ratio has not broken to 55 yet. It is holding near 59, but the setup remains valid. What changed this week is the macro backdrop got dramatically more complicated. The Iran war escalation, the dollar spike, the yield move. This is a new layer on top of the physical story we covered last week. And that new layer is exactly what I want to walk you through today. My name is John, 15 years in FX and commodity markets before I ever pointed a camera at myself. I left that world because I believed the people sitting at home watching their savings deserved the same quality of analysis the institutions were getting. That is what we do here. Everything I show you today comes from publicly available sources, and I will name everyone as we go. 3 things you are learning today: what the dollar trap actually is and why it matters right now, how rising yields create a physical silver squeeze dynamic that most analysts are not talking about, and how to use the 3 lanes framework to decide whether this macro shift is a threat to your metals position or a setup. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, do it now, because what we are building here week by week is a framework you will use every time the macro noise gets loud. So let me show you exactly where markets are sitting this morning. Gold is trading in a range of $5,149 to $5,223 today, with the current level near $5,169 as of the morning session on March 11, 2026. Silver is holding near $88.42 with a session range of $87.84 to $89.44. The US dollar index is near 99.0, with resistance sitting at 99.57 and the psychological 100 level above that. The 10-year Treasury yield is pressing toward 4.16%. And this morning we got the February CPI print. Headline came in at 2.4% year-on-year, core at 2.5%. Both multi-year lows. Both matching expectations. On any normal week, that CPI print combined with a stable dollar would be a mild positive for metals. This is not a normal week. Here is what triggered the dollar spike. US and Israeli strikes on Iran earlier this week drove an initial surge in safe haven dollar demand. The DXY spiked hard. Then President Trump signaled the operation may be concluding soon, and the dollar partially retreated back to near 99. But the yield market did not fully retreat with it. The 10-year is still at 4.16%, reflecting fiscal pressure, higher for longer rate expectations, and inflation concerns tied specifically to energy prices from the Iran disruption. That divergence between a partially retreating dollar and a yield that is not retreating is the tension at the center of everything happening in metals right now. Drop in the comments right now. When you saw the Iran headline this week, what was your first reaction as a metals holder? Did you add hold or think about trimming? I want to know. The comment section here is a real-time sentiment tracker, and I read every single one. Now here is what most people are saying about this setup. They are saying strong dollar plus rising yields equals sell gold, wait for the dip. And I understand that framing, it is historically reasonable, but here is where it gets complicated. The classic dollar-gold inverse relationship assumes that when the dollar strengthens, it is because the US economy is strong, real yields are genuinely positive, and there are better alternatives to holding a non-yielding metal. That is the textbook version. What is actually happening right now is different. The dollar is strengthening partly because of war-driven safe haven flows, not because the US economy suddenly became structurally sound. And the yields are rising, not because growth is accelerating, but because of fiscal pressure and inflation concerns tied to an energy shock. When I pulled up the CBO's most recent deficit projections alongside the yield curve this week, the picture that comes back is not a strong economy, strong dollar story. It is a higher inflation, higher deficit, higher yields story. And that combination, historically, is not bearish for gold. It is the dollar trap. Here is the best way I can explain the dollar trap in plain English. Imagine two escalators in the same building going up at the same time. One escalator is the dollar, one escalator is inflation. In normal markets, they run independently. Sometimes one goes up while the other goes down. The dollar trap is when both escalators run simultaneously. The dollar goes up, which should hurt gold, but inflation goes up at the same time, which compresses real yields and supports gold. The two forces partially cancel each other out, and what is left, what is not canceled out, is gold's safe haven premium from the geopolitical event that started the whole chain. That safe haven premium right now is real, it is documented, and it is why gold is holding above $5,100 against headwinds that would have knocked it down in a different macro environment. Here is what the February CPI data specifically tells us, and this is the part that matters for the next 2 months. The 2.4% headline print does not yet capture the energy disruption from the Iran war. Analysts cited in reporting this week noted explicitly that April and May CPI prints will be the ones that reflect that energy surge. So the market is currently pricing a 95% probability of no change at the March 18th Fed meeting, which is next week, and rate cut expectations for the full year have compressed from 2 cuts down to potentially 1, timed to September at best. That compression of cut expectations is what is keeping the 10-year yield elevated at 4.16%. And the forward risk is this: if the Iran conflict extends and oil stays above $90, the April CPI print could reaccelerate. A reaccelerating inflation print would push the 10-year toward 4.40 to 4.50%, strengthen the dollar further toward 100 and above, and simultaneously increase gold's safe haven premium as real yields compress further. That is the full dollar trap mechanism playing out in sequence. If you know someone who holds gold or silver and has been watching the dollar this week feeling nervous about their position, share this video with them right now. This is exactly the framework they need, and they are probably not finding it on their own. Now let me show you the silver dimension of this story because it is different from gold and it is being underreported. Most of the commentary this week is focused on gold versus the dollar. The silver story is about what rising yields do to paper market mechanics. Here is how it works. When the 10-year yield sits at 4.16%, holding a leveraged long position in silver futures has a real cost of carry. You are financing a paper position against a yield benchmark that is not trivial. At these yield levels, the economic calculation for a speculative long holder shifts. You are either rolling your contract forward, which costs more as carry increases, or you are taking physical delivery instead. Both of those choices reduce what is called the coverage ratio, the relationship between paper silver claims and actual registered physical inventory at COMEX warehouses. Think of it like a car park that sold 500 parking permits for a car park that physically holds 100 spaces. That works fine as long as not everyone shows up at the same time. But when the cost of holding your permit goes up because parking just got more expensive, some permit holders start asking whether they actually want the space. And when enough of them make that decision at the same time, the car park suddenly has a problem it did not have before. That is what elevated yields are doing to silver paper markets right now. Not dramatically, not overnight, but directionally. The Silver Institute's documented structural deficit, which we covered in detail last week, is the backdrop against which this yield-driven delivery pressure is occurring. Those two things together are what makes the silver setup in this macro environment more complex than the headlines suggest. The UK angle here is worth flagging directly. For British investors holding silver through a SIPP or as allocated metal, the GBP/USD dynamic adds a layer of currency risk that US investors do not face. A strengthening dollar, DXY pushing toward 100 and above, means the sterling value of your dollar-priced metals position is being eroded at the same time the dollar price is holding. The LBMA published vault data showing allocated silver drawdowns that have continued into early 2026. So the physical supply picture in London is consistent with what COMEX data is showing on the other side of the Atlantic. The physical tightness is not a US-only story. The geopolitical layer underneath all of this is what I want to address now, because it is the wild card that makes every other variable uncertain. The Iran strikes this week introduced a scenario that precious metals markets had not fully priced before Tuesday. Oil moved, the dollar moved. Safe haven flows went into both dollars and gold simultaneously, which is itself unusual because normally dollar strength and gold strength trade off against each other. When both move up together, it signals genuine fear rather than a repositioning trade. Central banks, and here I am drawing on the World Gold Council's data, which has tracked sovereign buying consistently above historical averages for 2 consecutive years, do not react to week-by-week events. They react to decade-long structural concerns. When I look at the pattern of central bank gold accumulation over the past 24 months, what I see is not a reaction to the Iran news. What I see is a multi-year decision already in motion that the Iran news is simply sitting on top of. These are not traders checking price charts every morning. These are reserve managers making multi-year allocation decisions. And the direction of those decisions has been consistently toward gold and away from pure dollar exposure. De-dollarization is a decade-long structural process. It is not a Tuesday event. But what Tuesday's events showed us is that when a geopolitical shock hits, the flight to safety increasingly includes gold alongside the dollar. Not instead of the dollar, but alongside it. That is a structural shift from the pre-2020 playbook. The Bank of England's reserve data and LBMA vault activity are both consistent with this pattern. The institutional conviction in physical gold at the sovereign level has not wavered because of a dollar spike to 99. If anything, a dollar spike driven by a geopolitical shock reinforces the diversification argument that was already driving the buying. The industrial demand picture for silver sits underneath all of this macro noise, and it does not care about the Iran war or the DXY. The Silver Institute's structural deficit is driven by solar photovoltaic demand, AI hardware infrastructure, semiconductor fabrication, and medical applications. None of those demand drivers paused this week because the dollar moved. Silver is not like oil, where you can watch the price move on a headline and directly connect it to the underlying demand. It is hidden inside every solar panel, every data center connector, every advanced chip. The UK's own energy transition, tracked by the Office for National Statistics, is accelerating domestic solar installations in a way that adds incremental British demand to a globally tight market. I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the data shows is the direction of demand, and that direction has not reversed because of a geopolitical event or a dollar move. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate the noise from what actually matters. Lane 1, the paper market, the blue lane. The CFTC commitment of traders' data this week shows managed money positioning in both gold and silver, navigating a complex week. A dollar spike, a yield hold, a geopolitical shock, and a benign CPI print all in the same 5 days. The paper market absorbed all of that without a dramatic long liquidation. That resilience in positioning is meaningful. Lane 2, the physical market, the silver lane. LBMA vault drawdowns continuing. COMEX delivery preference elevated relative to rolling. The Silver Institute deficit in its 3rd consecutive documented year. Physical is tight, and the yield environment is making paper long positions more expensive to hold, which directionally supports delivery over rolling. Lane 3, the macro lane, the gold lane. DXY near 99 with resistance at 99.57. 10-year yield at 4.16% with forward risk of 4.40 to 4.50% if Iran energy disruption feeds into April and May CPI. February CPI at 2.4% headline, a multi-year low that paradoxically does not reduce the forward inflation risk because the energy component has not yet arrived in the data. In 15 years watching currency and commodity markets, the setup I find most instructive is not when all 3 lanes are screaming in the same direction. It is when 2 lanes are aligned and 1 lane is creating apparent contradiction. Right now, the physical lane and the macro lane are both pointing towards structural gold support. The paper lane is the one creating the noise, the dollar spike, the yield move, the intraday volatility. In my experience, when paper noise contradicts physical and macro alignment, the paper noise tends to resolve in the direction of the underlying structure. That is not a guarantee. That is a pattern. And patterns are what 15 years in this market teach you to recognize. When the paper lane is absorbing geopolitical shocks without long liquidation, the physical lane is showing documented tightness, and the macro lane is operating inside a dollar trap where inflation and dollar strength are partially canceling each other. The historical pattern has been for gold to hold its structural level and for silver to follow with higher volatility. Framework, not forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The March 18th Federal Reserve meeting. Not the decision itself. A 95% probability of no change is as close to a certainty as markets ever give you. What I am watching is the language in the statement and the press conference. Specifically, Does Chair Powell explicitly acknowledge the Iran war energy disruption as an upside inflation risk? If he does, the market will interpret that as a signal that the September cut timeline is at risk. A September cut being pushed to December or later would extend the higher for longer environment, keep the 10-year yield above 4.16%, and sustain the dollar trap conditions we discussed today. In that scenario, the gold safe haven premium and the physical silver squeeze dynamic both have longer runway. If Powell downplays the Iran disruption and signals confidence in the inflation trajectory, the opposite interpretation takes hold. Yields could ease back, dollar softens, and metals get a more straightforward tailwind from a weakening dollar. Either way, the statement language, not the rate decision, is where the real information is on March 18th. Watch the press conference, not the headline. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and tell you what you want to hear. I am not doing that. The optimistic picture for metals looks like this. The Iran conflict extends. Oil stays above $90 through March. April CPI accelerates above 2.7% as energy feeds into the print. The Fed holds in March and signals it cannot cut in September either. The 10-year pushes toward 440 to 450%. Real yields compress because nominal yields are rising on inflation rather than growth. Gold breaks $5,500. Silver follows toward $95, driven by both safe haven flows and ongoing physical delivery pressure. The cautious picture looks like this. President Trump's signal that the Iran operation may conclude soon proves accurate. The conflict ends within 2 weeks. Oil drops back below $80. April CPI comes in flat or lower. The Fed holds in March but signals growing confidence in its September cut. The dollar rallies through 100 to 102. Speculative long positions in both gold and silver deleverage. Silver tests $80. Gold pulls back toward $4,800 to $4,900. Both of those outcomes are genuinely possible right now, and anyone telling you they know which one is coming is guessing. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The Iran situation, the oil price, the April CPI setup, the Fed language on March 18th, the market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers. First, looking at the dollar trap mechanism we covered today, do you currently see the DXY strength as a threat to your metals position or as confirmation that something structural has changed in the gold-dollar relationship? Second, on the Fed meeting next week, what specific language from Powell do you think would be most significant for silver specifically, not gold, silver? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going directly into the March 18th Fed meeting. I will break down the statement language in real time and show you exactly how to read Fed communication for its metals implications. That is a skill worth having, and most channels will just give you the headline. And if someone in your life is watching gold and silver this week and cannot make sense of why metals are holding up against a strong dollar, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.